If someone said to you, I've got a whole life insurance policy and I put away $200,000 per year, and I took that policy out because I was interested in the cash value, and here are the ways I use the cash value. Here's all the benefits to it. How would you react? Well, most people would hear $200,000 per year going into a whole life insurance policy and say, what? Why on earth would you do that? Tell me more, because what I've heard about whole life insurance has not been that good. But if you're putting away $200,000 per year, you're doing that every year, right? Not just one time. Yeah, every year, that's how much I pump into the policy. Okay, tell me more about it because you've got my curiosity. And then we listen, and then typically what happens? We go on Google and we do more research on our own, perhaps YouTube as well. So why I mention that is when it comes to whole life insurance products where individuals are interested in the cash value, what is very beneficial to understand is what is the process that individuals go through who have already taken out policies and successfully used them. We've got up on the board how to copy the wealthy with cash value life insurance. So if you hear of someone putting away $200,000 per year, or say $2 million per year into a whole life insurance policy, would you want to understand exactly why they are doing that? How are they using the policy for the cash value benefit? What's the growth rate? How do loans work? Like, what are the details? There has to be something there if they're doing that. I know I would. Anytime I speak with a business owner or someone who is very, very far ahead of me with respect to business, I'm asking them a lot of questions and I'm trying to learn from them so I can take some of the ideas or some strategies they've implemented and implement it into my own business. That's often how we learn from each other. So what we're going to discuss today is, one, the product, what often attracts individuals to whole life insurance. When I say individuals, those putting away large dollar amounts. And then also with that product, what are those same benefits that they appreciate after they've owned a policy? So I'll hit on what initially attracts them and what they actually like about it once the policy is in force. And then two, what's the process they go through? Hopefully this gives you some ideas as far as questions and such to ask, or create your own vetting process when you're considering a policy for yourself. Seeing what others do or learning from others will really help you make an informed decision up front, because it can be a big decision for many, especially if you're considering a large dollar amount. So with respect to the cash value, we've got the three core benefits here under the product section. Cash value, core benefits, safe, liquid, and tax-free. Let's go through a couple details on each of those points. Safe, IRR, stands for internal rate of return. I like to refer to this often as the net growth rate. You see 3 to 5% there. If a policy is set up properly and positioned with one of the major mutual companies, that 3 to 5% is a great range to state to properly set expectations. Based on the historical data we've seen when we look at actual whole life insurance policies, typically with the 4 major mutual companies, what have they actually produced? We've seen them fall between that 3 to 5% range. Historically, we've even seen it higher than that, but to provide conservative numbers, I do prefer to state the 3 to 5% internal rate of return. Then we've got peace of mind. So we do like to refer to this, and a lot of people express this in one way or another, that it's a peace of mind product. And what I mean when I say that is, regardless of what's going on in the stock market, in the economy, if that policy is producing, call it a 4% IRR, a net growth rate, that'll just continue to occur regardless of what's going on in the economy. In 2008, in 2020, when COVID first hit and the market took a severe dip over a short period of time, there was a lot of interest generated in whole life insurance because of that peace of mind feature. I don't have to think about it. I know it will continue to appreciate. That's often attractive to a lot of individuals when they're exploring the cash value benefit. Liquidity. So this one's huge, especially for business owners and real estate investors. So we can use the cash value similar to a line of credit. How it works is, once you have money in cash value, let's pretend you've got $100,000 in cash value, it's earning a 4% internal rate of return, so it's growing by 4% per year. Regardless if you let that cash value sit and grow, or if you elect to take a loan against it, it'll continue to compound at the same 4%. So for example, I've got 100 grand, I elect to borrow at $50,000, I'll continue to earn dividends on the full $100,000 as if I never pulled the 50K. Now, there are some things to be aware of, such as when I borrow the $50,000, I'll see my death benefit drop by 50K. There's also a cost to borrow on the $50,000, a loan interest rate that goes to the insurance company. It's a lot like a piece of real estate. If I've got a piece of property that's appreciating at 5% and I elect to take a loan against half of the available equity, I'm going to pay interest on the amount I loaned. However, I'll continue to earn that 5% appreciation on the entire home value. So you'll see a lot of people involved in real estate attracted to that feature, especially when you couple that with the peace of mind feature and they know it just continues to appreciate. It becomes very attractive in that respect. And what I've noticed with individuals we work with that have paid in 7 figures per year into policies, they often want to compare the product with what they are doing right now. So for example, someone's investing in real estate and they're considering a policy where they want to put away $1 million per year, and they specifically want to leverage the cash value for real estate opportunities. What they want to see is, if I just continue to use cash in the bank for my real estate deals, what does that look like? And then lay that out for me side by side where I can compare it with the policy and factor in the cost to borrow, the net growth rate I'm receiving, so I can see when I have more money in my bank account versus when I have more money in the whole life insurance policy. Just provides a side-by-side comparison. Then the third core benefit, we've got tax-free. So tax-free, yes, I can access my cash value tax-free, but there are ways where I can mess it up. So technically, how the cash value works is that it grows tax-deferred, and I can access it tax-free if I do so properly, but it's very important to avoid a taxable event. One commonly known taxable event is a modified endowment contract, a MEC. There are other instances that can trigger a taxable event. I would check out any of our videos that go through taxation and whole life insurance products for a full breakdown on that. But having awareness on that is something we will see individuals considering large policies do. And really what they want to make sure of is, one, that we avoid it, and then two, that we, the agent or the agent you're working with, is setting it up so you won't ever have to worry about that. It's easy to prevent, but we've got to do things right. The death benefit often does have value as well. We see a few bullet points there, both on the personal and business side of things. But let's go through the process here. So when someone is interested in a whole life insurance policy, it starts there with interest. They're interested in learning more, and they'll often do research before connecting. And that's typically what most of us do. For example, if you're interested in a new car, but you don't know which one you want to buy yet, do you go straight to the dealership and let the salesperson educate you? Or do you do research online first and check out the different models? Maybe you price shop. Maybe you look for a certain year, a model that you really liked when you were a kid, whatever it might be. You're doing research first. This way you know what you want when you actually go to the seller. Same thing with whole life insurance. What we often experience is people reach out to us and they're educated on the product. They know a lot about it just from the research they've done before we even speak with them. And what they're researching about is the product, company, and then sometimes the agent or agency as well. That is important. Here's a big one. What I have experienced, both on the individual and always the corporate side, is when a large policy is being considered, there's often more parties involved. We've got third-party involvement. So here we see CFO with corporations. I can give you a quick experience on this. Years ago, we worked with a bank. We still work with this bank in setting up their bank-owned life insurance policies. And when the bank makes the decision as far as how much they want to pay in, what companies they want to select, they are going through a thorough process. And you've got the CFO. You've got an individual in the boardroom who was a former examiner, very, very sharp guy, looks at all of the details, and another executive. That's just with me connecting with them. Then afterwards, they do additional research. So they're really vetting the product here, but you've got multiple individuals looking at it, asking the right questions to determine if it is a fit. Attorneys are often involved with individuals, typically tax attorneys. Sometimes they are well educated on cash value life insurance, and they know the right questions to ask an agent that a consumer might not know. This is extremely valuable in my opinion. And then sometimes a fee-only advisor as well, which is someone who can come in, analyze the product. Perhaps they have prior experience selling it, but what they're doing is just representing that client to make sure that the product is set up properly, because the agent selling the product is compensated through commission. So it can be difficult in some circumstances for that agent to have a true, or I should say, act as a true fiduciary. That should be the case all the time, in my opinion. However, it's not uncommon when working with individuals considering what I've seen, $500,000 and up, bring in a third-party advisor, which could be a fee-only advisor or an attorney who is compensated through fees. That's not uncommon at all. Some key points of awareness. Typically what we'll always show and what is requested in cases like this where someone's considering a large policy is as follows: the guaranteed values. Look at the worst case scenario. Don't listen to someone saying, the guarantees never happen. Yes, companies typically deliver greater than what we see on the guaranteed side of an illustration, but look at them. How I like to view it is, if I see the guaranteed values, I can set expectations properly, knowing that this is a potential worst case scenario. It's always done better, but when I look at that, is it an absolute deal breaker saying if it does that, I don't want it? There's no possible way. Or do I look at it and my initial reaction is, okay, it's still designed where I've got a lot of cash value up front, the IRR is decent, I'm good with that. And if I know it always does better, I love it. So let's move forward. Point is, looking at the guarantees is extremely valuable. Historical performance, so this is a big one in my opinion, because when it comes to cash value life insurance sales in general, what often triggers buyer's remorse is when someone is shown an illustration, we look at it over the long haul and it projects these beautiful values 30 years down the road, and then the actual results are significantly less. And then the individual who took out the policy says, well, the agent told me it should deliver cash values similar to what was on that illustration. Why is it so much less? Because now they have less money than what they thought they would. It's their money at the end of the day, not the agent's. So looking at historical performance allows one to see, has this company actually delivered strong cash values? And if it's sometimes, well, what was done with those products that have delivered strong cash values where the consumer has been satisfied, as opposed to what was done in situations where the product hasn't delivered strong cash values. What we don't want is a situation where someone feels like they were overpromised but then underdelivered. No, we don't want that. So historical performance can be beneficial to look at because it's very big in the life insurance industry. And then awareness. Commissions are minimized. So if a product is set up with minimum commissions, what that often results in is the strongest possible cash value, particularly on the guaranteed side of an illustration. So if I have the guaranteed values as high as possible, that's going to result in minimum commissions in almost every situation. And then the last thing, just to hit on, a quick example here. If you're considering a policy of any size, how do I know if it's set up correctly? That first year cash value generally should fall somewhere between 85 and 95%. Sometimes it might be closer to 80% depending on the company and product, but the majority of your payment should be in cash value initially. The break even should fall somewhere between 3 to 5, sometimes 3 to 6 years if I receive a poor health rating or I start a little bit older, somewhere between 3 to 5 to 3 to 6 years. And then company selection, selecting one of the major mutual companies is extremely beneficial in my opinion, because going back to the historical performance, we've seen them deliver strong actual cash values, not just good looking illustrations. So I hope this video was helpful. If it was, please hit the like button, subscribe for more. You can also leave any comments or questions below, and I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.